So we had a lot of stimulus go into the market, fiscal and monetary. We took it out, and now people are really almost in a panic, some people, worried about where we're going. What is your sense of where we are?
David, first of all, thanks for having me on. And obviously, everything's a lot more murky than last time I was on. So what I would tell you is this. One, I've never seen as murky a period as we're in right now. I think the answer is across the spectrum. We're going to know a lot more in the next 2 months. Let's define first what we're looking for. Everybody talks about slowdown versus recession. Remember, recession, at least by our traditional definition, means 2 quarters of negative GDP growth. I don't think that's going to happen. I do think there's going to be 3 or so data points that we're all going to pay close attention to in the next 2 months that have to show decent results. Obviously, inflation. Let's assume that the Fed funds goal, public goal of 2 to 2.5% is going to look light, and it's somewhere between 3 to 4% before it's all done. To be at the better end of that, you're going to hope to see inflation publishing with a 7 by midsummer and with a 6 later in the summer. Secondly, energy prices. Do they hang in where they are, or do they go higher? That's always going to have a big influence at the pump. I would note that the biggest companies, the oil majors, have not increased their production budgets, which kicks in over the intermediate term. So they're telling you that in some ways today, the belief is it's a big cycle. And finally, where is housing going to be? Mortgage rates up 200 plus basis points in just a few months. The last time we saw that, it cooled housing down about 15%. We need housing to do better. To the extent this all happens, I believe that we will be in a period of slowdown, certainly, but that there's enough tailwind in different parts of the economy to keep this from being going to a full-blown recession.
So we're certainly seeing a slowdown, let's put it mildly, in the equity markets. It's been really a roller coaster, but down substantially this year. Is that translating into your business? Are CEOs less eager to make deals right now?
Absolutely. I would say that the biggest factor in deal making is going to be confidence. And confidence comes from feeling certain in your decision making, certain in the outcomes of various moves you're going to make. And right now we are in an uncertain environment. CEOs can make judgments when there's a high growth environment. They can equally make judgments in a lower growth environment. Right now, it's certainly a difficult period, but things are happening. I tell you, David, that volumes remain okay. It's actually the value, the overall value of transactions that's down 35, 40%. And that tells you that CEOs are focusing still on doing moves that are more tactical than strategic, but doing them. And they are getting things financed. I would say, particularly if it's out of the equity markets, not so, but for investment grade, no issue. And for below investment grade, a lot more expensive, 300 basis points or so higher than it would have been even a few months ago. But given what's going on in the leveraged loan market, which is very robust, taking off a lot of the downward impact in the high yield market in terms of issuance volume, things are actually still, frankly, getting done.
From your experience, from your vantage point, is it possible we're all overreacting?
That's not a word I would use. No, I think this is an environment where, if anything, you want to react aggressively, act aggressively, get ahead of it. I'm someone that certainly thinks, and as you and I have talked about for quite a while, that getting to rate raises had to happen. Would have been perhaps better happened sooner. There are reasons for that it didn't, but the rate had to happen, and you want the curve to happen steeply. So I believe getting ahead of it, particularly because we had an asset price environment that was just too robust. And it is no surprise that when that happens, you will get corrections in certain areas of the market, violent corrections, to overcompensate. I do not think in any way it is an overreaction. I'd rather see us react strongly so that we can figure out how to guide the economy down, but still keep it in a growth mode. And again, you have a lot of tailwind in different areas to suggest that that is entirely possible.
So as you say, you don't see a recession as of right now. You don't see it in the traditional sense. Some people say part of that's because we're going into this situation of some sort of downturn with much stronger household balance sheets. People have a lot more money in their bank accounts, so to speak. And by the way, the banks are much better capitalized than they've been in some prior areas. Is that possibly a drawback for the Fed, which would require them to go further in the rate hikes because, in fact, we have more momentum going into it?
So first of all, I believe the Fed will do what it needs to do. Jay Powell told you, he looked back to Paul Volcker as a personal hero. I took that as a pretty interesting signal. What I would tell you is we're starting, obviously, correct in strong recession. The last time, the last 4 big upticks in rates, they went up 300 basis points. They started at a 3% Fed funds rate. Here we started at 0. That gives us, I believe, more cushion than not. I also think the consumer is stronger. Balance sheets are stronger. Obviously, Walmart and Target last week talked about a cost issue, a price realization issue. They didn't really talk about a consumer weakening. They talked about a consumer changing preference, but still staying strong. And then, of course, David, we have employment levels at really historic lows, and we still have 10 million jobs waiting to be filled. I think all of this gives us protection. I don't think, that said, the Fed will, I think they'll be nimble. I think they will act to facts on the ground. And the most important thing, which they've said, and I fully support, is getting inflation back under control. And remember, we still don't know how much of the 8+% is structural versus transient. And the goal at some point, the question is going to be, is 2% the right level to end up long term, or is it something different? Time will tell.
When we look at what the markets have done thus far, our eye is naturally drawn to tech. Tech's really gotten hit particularly hard here. As you look at potential deals for the CEOs that you represent, the CFOs you work with, are they particularly reluctant in the tech area? Has the bloom truly gone off the rose in M&A and tech?
No, it hasn't. It's certainly hard to price things and evaluate things in the current environment, but tech obviously is a huge and growing sector of our economy, of the global economy, and is enabled, frankly, companies across the spectrum to do better. So when I think of tech, I think of every company a big tech company, not just what you might define as traditional tech. I do think, that said, that we've had a return to a traditional valuation metrics. Companies ought to earn return, they ought to have cash flow, and they ought to be valued as such. There was a period of time when that became less important, and I think the market, therefore, is having that correction now. So while it would be hard to do a tech deal as we speak right now, I have high confidence as we get through this period of uncertainty that it will continue to be at the forefront of the economy, and frankly, the forefront of my world.
When the markets were on their way up and we had a lot of various forms of stimulus coming in, a lot of the talk was about environmental, social, and governance, ESG investing of various sorts. I know that's something you've been active in. Has that been put in abeyance for the time being? Is that put off to the side until we get through
Not
this?
at all. That's a great question, but not at all. Most companies across the spectrum, including energy companies, I think are more committed than ever, and in all 3 aspects of ESG. And you see commitments being made. I think that that is seen as responsible corporate citizenship. Stakeholders demand it. And frankly, the best companies figure out how to give a great financial return to their shareholders, and also a great return on ESG. And if you think about what it means for recruiting, if you think about what it means for customer satisfaction, United Airlines can talk to its customers about the kind of green fuels, biofuels it's using, it makes a big difference. So by no means has it been on the back burner. And when I see that there are cutbacks in certain discretionary spends, it's not in that area. It might be in advertising and promotion, for example, where I do see some already cutback. It might be modestly in tech. I already do see cutback, but it's not going to be in the ESG area.